Today, I want to start with a conversation that I had with Norman and Marie, a couple of dear friends of mine. Norman recently retired and they are looking to relocate to South Carolina. So naturally, they're looking at their retirement, their finances, and what their next chapter would look like. During one of our conversations, they mentioned that their bank had talked to them about investment services. And they had a very simple question for me. What is the difference between the bank and the investment part? And that question inspired today's video because you may walk into your bank and assume that everything is protected in the same way. You may have your checking account there, a savings account there, even a CD. And now someone at the same bank is talking to you about investments. Welcome to Your Money Always Matters. My name is Ladia and I am a retired licensed financial professional with over 40 years in the financial services industry. And my goal is to bring practical information to you so that you can have meaningful conversations with your family and other financial professionals. And so the important thing to remember is this: the bank side and the investment side may not have the same relationship. Your traditional banking products, such as your checking accounts, savings accounts, CDs, and some money market deposit accounts, are deposit products. If they are held at an FDIC insured bank and meet the requirements for coverage, then they are generally protected under FDIC insurance up to the applicable limits. But investment products are different. If you buy a stock, a mutual fund, or another securities investment through someone at your bank, it does not mean that it is FDIC insured just because you had that conversation at the bank. That's why sometimes you may see signs that say not FDIC insured, not a bank product, and may lose value. FDIC protects eligible bank deposits. FDIC does not protect a mutual fund. It does not protect a stock. It does not protect a bond just because you bought it through an investment individual at your local bank. And that brings us to SIPC, which stands for the Securities Investor Protection Corporation. And that's very different from FDIC. If a SIPC member firm fails and customers' investments and cash go missing, then SIPC may provide protection and coverage for the missing securities. And that will be based on the applicable amounts and the rules for SIPC. But SIPC does not protect you from market loss. So let's say you bought a stock for $100 and it declines to $70. Well, SIPC will not reimburse you for that loss. That's investment risk. SIPC insurance is for something totally different, and that's when a member firm, brokerage firm fails and customers' securities and cash are involved. So I don't want you thinking that FDIC insurance and SIPC insurance are the same, because they're not. And if you find this behind the scenes financial education helpful to you, then now is a good time to subscribe to my channel, because we talk about questions that most investors don't know to ask. Now let's go back to Norman and Marie's question. If I were sitting across from that bank's investment representative, I would have these three questions. Who is the broker-dealer? Who do they clear through? And who has custody of my investments? And here's why that matters. Because when you buy or sell a security, there's a lot that goes on behind the scenes. The trade has to be processed, it has to be cleared, it has to be settled, and it has to be recorded properly. And depending upon the brokerage arrangement, one firm may have the relationship with you, while another firm may have the clearing, custody, and other back office functions. The introducing broker is the firm that you see. They're the ones that you have the relationship with. The clearing broker is the one that takes care of all of the back office functions, the clearing and the settlement for the investment accounts. I've seen both sides firsthand. I've worked for a large brokerage firm that was both the introducing firm as well as the clearing firm. And then I've also worked for a broker-dealer that was the introducing firm and also had a separate firm for clearing. And so when I say that the name on the building is only the first part of the story, that's coming from real experience. So if you're sitting at your bank and someone is talking to you about moving your retirement or your investment assets, I wouldn't necessarily say yes, nor would I necessarily say no. I would ask questions. I would want to know, is this a bank product or is it a security? Is it FDIC insured or does SIPC coverage apply? I would also want to know who the broker-dealer is, who they clear through, and who has custody of my assets. Also, you'll want to know what fees are involved and if there is any additional coverage when it comes to SIPC. And these are some of the important questions because they help you to know where your money is going and what is going to happen to your money when it gets there. Those questions help you understand what's being offered. Because your bank account and investment account may be under one roof, it does not mean that they are the same product, that they are protected the same, or that they are held by the same financial entity. Before you move your money anywhere, know what you are buying, who you're doing business with, who they clear through, who is the broker-dealer. Is it a bank product? Is it a securities product? Is it FDIC insured or is it SIPC insured? All of that information is important knowledge to have as you decide where you want your money to be. And just remember, it's your money, your questions, and your right to understand because your money always matters. And in my next video, I'll be bringing you more information about SIPC coverage.